Living benefits. This is what we pride ourselves here at MRC. This is our niche product. Living benefits with our insurance carriers. Covers you if you got critical, chronic, or terminal illness. What does that mean? You experience a cancer, heart attack, stroke. Okay? You have 24 months to live. Or you get in a bad accident. You're not able to use 2 of your 6 activities of daily living. You can't bathe yourself, feed yourself. The insurance carriers will pay you out as if you passed away. That's a big plus right now. Life insurance has changed, guys. The landscape of insurance is not like your grandma's and grandpa's old life insurance policies. Okay? Living benefits are here to stay, guys. Does your life insurance policy do this? Cover you in case you get sick. Major organ transplant, blindness, Lou Gehrig disease, end-stage renal failure, chronic illness. Okay? And if you don't get sick, then we have a lifetime income rider, once activated, could give you guaranteed income for life, money that you will not outlive. So you don't see yourself working again at a Walmart or a McDonald's to supplement your retirement income. Critical illness. Now these statistics right here, guys, they should be alarming, and you should take this into consideration because the average age of a heart attack, stroke, or cancer is 43. Never would have thought that. The average age of a bankruptcy is 44. 62% of all BKs are due to medical expenses. 78% of them had health insurance. Most Americans will survive, and they cannot earn income. They can't go back to work. Now, also check this out, ladies and gentlemen. If you hit the age of 65, now you have a 70% chance of experiencing a critical illness. Why should your family wait until it's too late? Critical illness, 90% of Americans do not have long-term care. 70% of Americans will require long-term care. 40% will be in a nursing home. Average stay is now about 2.9 years in a nursing home because we are living a little longer, right? There's advances in science and medicine. And the average cost of these nursing homes are about $219 per day. Now, where are you going to get that $65, $100 a month to take care of yourself? You're right, your 401k. That's where a lot of the 401ks are going to be depleted within those first 8 years. So that's why we're very big on living benefits. If you're going to have any kind of life insurance policy, make sure you have the right one and have the best one for you and your family. Now let's talk about the lost decade. Okay, we're going to go back and give you a little history lesson on how money works. Okay, so you could see the difference between the middle bucket, the second bucket, and the third bucket. Let's go back to 1999. Get $100,000 and you're going to put it into a mutual fund. That's the red line. And the blue line is going to represent an annuity product that we have, an index annuity product. So today we have Bob's putting $100,000 in mutual funds, and then we have Billy putting $100,000 in annuity. As you can see, if you put your money into a mutual fund or 401k product, your money it's in the market. It's being risked, right? So if the market goes up 20, 30%, your money also gains 20, 30%. But when the market goes down 20, 30%, so does your money. Okay? So let's take a look back in 1999. If you guys go back to 1999, that's when we had the dot-com era. A lot of people were making monies in mutual funds, and they were ecstatic. And there, Billy had $100,000 in annuity, and his annuity has a cap. Remember that we talked about? We had a 2% floor and a 14% cap. So if the market went above 14%, he got capped out. So, of course, for the first year, your money did very well in mutual funds. But then we had the dot-com crash. And that same $100,000 that grew to 119 all of a sudden started losing value. Now it dropped down to 107. Well, with our annuity products that we offer here at MRC, zero is your hero. What does that mean? When the market goes down, your money is not invested in the market. You sit out. You sit out the bad years and only participate when the market is doing good. So for the next few years, of course, we had events like 9/11 happen. The housing market started kind of rebounding. Low interest rates went down to an all-time low in 2001, 2002, and as you can see with our annuity product, nothing much was moving in the S&P 500 or the stock market. So our client was getting 0% crediting every single year. But let's take a look at 2003. What happened in 2003? The housing market started to rebound. Mutual funds were going up. The stock market was going up. Okay, and look what happened to Billy. He started at 113,000. As the market started going up, he started going up with the market. In 2003, our $100,000 went all the way down to 71,000. And now as the market started to go back up, we're starting to go up with the market. Back in 2008, before the fall of Lehman Brothers or the mortgage collapse, you're back to 119. In our annuity product, you're back to 167,000. Long story short, guys, over 10 years, our annuity product doubled your principal from 100,000 to 213,000. Where if you had your money in a mutual fund for the 10 years, in 2011, you probably gained about $2,000. This is why they call it the lost decade, because those that are nearing closest to retirement can't afford to invest your money for 10 years to only gain $2,000. Does that make sense? Of course not. That's why indexing is one of the best strategies, and you need to find out more about indexing. For those that don't like graphs, here's everything broken down in number form. In 99, you had your 100,000, the market went up 19%, you made your 19,000. We had a cap right here because our cap just increased to 14 about 3 months ago, but this is when our caps were at 13. So your $100,000 went to 113. You see how your friend can make fun of you a little bit and saying, hey, I told you to invest with my guy and not with the agent at MRC. So let's take a look what happened the following year in 2001. The market went down 10%, so you lost a little bit of money. But our clients sat out. That year was a bad year. We do not participate in bad years. So you see the guy's account goes from 119 to 107, then it goes down to 93, goes down to 71, and we sat out those bad years. And the market rebounded until 2009. You see that big old hit of 38%. Again, we had a 0% credited rating that year. We didn't lose no money. At the end of 10 years, our account went up to 213,000. The other account, the mutual fund, was only at 102. The difference, guys, is only 6%. We're not promising our clients double-digit returns, 10%, 11%, 12%. This is very conservative. 6.3% was the difference. But the 6.3 was a big enough difference to double your original principal balance. That's the most important part to understand.